I had a conversation with someone the other day. We've got another office in Byron, and I was having a yak with someone over a cup of tea there. He said, tricky week in the market. Didn't know the guy, and he didn't know me. I said, well, yes and no. And he said, what do you mean? Market's down this and that. And I said, that's right if you're holding just like a blue chip portfolio of shares or just an index tracker. He said, well, what else can you do? And I said, well, in these more difficult times, this volatility. He said, yeah, it's crazy volatility. I said, you actually can buy volatility as an investment asset. He's like, and I got the stunned mullet look as if you smoked the front lawn. I've met it's in Byron, so it's a reasonable assumption. And it's like, well, no, there are financial instruments that during times of volatility simply go up to hedge out the position. Hey guys, welcome to this week's Money and Investing Show. This week we are looking at the increase in volatility that we've seen out of the market over the last few weeks. Lots of points to digest here. Some of this may be new, some of the terminology could be fresh, and if it is, feel free to reach out to our website, australianinvestmenteducation.com.au, where we can walk you through what these terms mean and how you can apply them. Meantime, don't just take notes, make sure you take plenty of action. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Good to be here, Mr. B. Outdressed as per normal, but we're going to get into a pretty meaty topic today, so you might need to take your jacket off.
Because red lining, red market.
Very nice. That's right. Timely conversation, I think, at the moment. A lot of investors and a lot of our clients have been asking us to discuss, and that is how to navigate market volatility. Let's really break this one down.
Volatility is your worst nightmare as an investor, and particularly if you're someone that's quite passive or maybe not as educated in the arts of optimizing investment markets. On the other side of the coin, volatility is an absolute gift from the gods if that's a strategy that you've been able to develop and I guess harness so that it becomes a value add for you.
Absolutely. I mean, I think of it from a trading perspective with what we do here in the options market. More volatility just means more income from selling calls. So for us running cash flow on demand, it's been great payday.
Yep, absolutely. And, so it always comes down to perspective at the same time. And there's no condescension when I say this. Most people have seen, a decent downturn in the value of their portfolio, whether it's their share portfolio, their superannuation. So it's something that has massive repercussions for investors when you see a sell-off in markets or alternatively a spike in volatility, those two things being very, very closely linked.
Totally. And I know we'll talk about fear and greed later on, but just to set the framework for today, AB, volatility, what is it and why does it happen? I mean, as far as I understand, if I go back to my uni days, volatility or risk is just simply the measure of uncertainty, right?
That's correct. And look, markets hate uncertainty. We've talked about this plenty of times. So when there's uncertainty, the discomfort within a market is typically reflected with a downturn. So if you've got an uptrend, nice what we call a bullish market's moving higher, you typically see volatility dropping and dropping and dropping down to very, very low levels. When the opposite or the inverse happens and you start to see either a correction in the market or a decent sell-off, volatility picks up. What we've got in this situation is there are a lot of world events creating uncertainty, and we also have a stock market that becomes self-fulfilling by selling off and spiking volatility higher too. So there are a couple of factors at play that sit here. Great opportunity though, as I'm sure we're going to explore.
Absolutely. So let's go through what are the three major reasons we've seen this volatility at the time of this podcast, at least.
Yeah, look, I think the political side of things have to be front and center. We've got a new administration in the US, we've got Trump version 2 and a tariff policy, which, look, to some extent isn't an unknown quantity because part of his mandate during the campaigning process, we're going to introduce tariffs. So you've disclosed that you're going to have tariffs. And now you have. So there's no surprise there. It's just following through on what he's done. Maybe that's the surprise that you've got a politician that actually is doing what they said they would do. But then the nature of those tariffs, I think, have possibly been a little perplexing in some instances and certainly very aggressive in others. And there's a bigger end game, I'm sure, that are in there. But that's been a major one, is this use of tariffs. So, you're going to be a trade partner of ours and we want to do business, but if you don't want to dance to our tune, we're going to tariff you at 25%. And if you have the audacity to complain about it, we'll double the tariff or even quintuple it in some instances.
It's fairly aggressive, to say the least, isn't it?
It is. And I think, secondly, what we've had, just going through some of the factors that have unsettled markets, from a geopolitical perspective, not just in the tariff space, but also in terms of foreign policy. So for many people witnessing the events in the White House where, President Zelensky and President Trump, Vice President Vance were sat there, and it sort of spilled into a bar brawl almost in terms of opinion, was probably not something that people would have expected. And I've got to be honest, it's not something I don't necessarily believe should have been played out on TV. It was all going along very well, and from what I understand from various sources, documents were to be signed for a ceasefire and a mineral deal, I suppose, and that all kind of blew up live on TV. And I guess, the US's goal out of it is the Trump administration and President Trump in himself is not a president of war. It's someone that doesn't like war, doesn't like conflict, and wants it finished. And that is a good outcome. We have to not lose sight of that. But the methodology for getting there really sort of hailed a new era that the US is not going to pussyfoot around. And, you could argue that, for the last 4 years, the Ukraine have been able to go to the US cap in hand and get effectively unlimited resourcing from Congress and from the Biden administration. That's not happening anymore. And that's aligned with the US's mandate of America First. And America First is great for the US, but how it starts to interplay globally becomes a little bit more of a challenge. Thirdly, in terms of the market turmoil and volatility spike that we've seen, we've had a tremendously strong run out of markets. And I've done the media rounds over the last couple of weeks with this. The NASDAQ has put on the best part of 300% in terms of price gain over the last 5 years, which is insane.
Could be affording to give back 15 or so percent every now and then.
So a pullback of 10 or 15 or even 20%, painful as it is if you're the person that's bought in at the high, in the scheme of things isn't that great. It doesn't look great on the chart, I'll give you that. So that starts to instill a level of panic where, okay, let's take fear, let's take some money off the table, which then kicks down further selling pressure and effectively self-fulfills. So 3 big factors there: human nature, geopolitics, and tariffs.
Can I add one to the list as well? Potentially with tariffs, a flow-on effect from that, we could see inflation come back, which I've noticed a lot of nervousness around. Higher inflation could potentially mean higher interest rates as well, which the market doesn't like. We want lower cost of borrowing. That's probably been something on the radar as well.
Exactly right. If you have something that's tariffed coming in, and so, I was just talking to one of my really good buddies in Italy. It's wine, like quite a sizable wine merchant, and there's 200% tax on wine, and obviously Italy is part of the European Union. He said, yeah, but the alcohol tax is about 42 cents a bottle, so you're adding 82 cents, which in the big scheme of things is not, wine is going to be 3 times the price. It's going to be an extra 80 cents a bottle.
Gotcha.
Which, if it's a half decent bottle of wine is neither here nor there. So
that's right.
There's a perception and a reality alongside that. But then that move up in tariff or wine tax, that is now 82 cents, not 42. So that's a 40-cent price increase, which is a price increase, which, as you rightly identify, is inflationary, which is a major concern when you're trying to stamp out the flames of inflation, and you've just gone through 3 cuts to try and show the world that, okay, we're on the other side of that. All of a sudden, the shoots of inflation are coming back up again. Big problem. So
a lot of fears, AB, that we've seen probably amidst a lot of headlines in the media, and also talking to some people out there in the space of markets, has been the slight fear of a recession returning in the US. Now, personally, I think that's largely far-fetched at the moment, because I think their economy's in a pretty decent spot. If we were to go down that pathway of recession-style indicators, which comes as a result of market volatility, what would we typically be looking at? Yield curve would probably spring to my mind. What are your thoughts?
Yield curve is one where you're sort of pricing in an interest rate cut and therefore lower interest rates if you're trying to avoid the notion of going into a recession, which is the exact opposite of what you probably would want to do if you've got signs of inflation. So there's that juxtaposition that needs to be handled by a central bank, in this case the FOMC, Federal Reserve, for what they're going to do over there. So you've got on one side, the risk of inflation, on the other is the risk of a recession, and the medicine for either of those is the total opposite of each other. So it's a bit of a problem in that regard.
Sorry, just for our listeners out there too, yield curve inversion also is when the short-term yield is paying more than the long-term yield, which is not what it should be. You should be getting compensated more for having your money locked up for a longer period of time, right?
That is correct. So you get that inversion. There's a possibility there. The second thing in terms of indicators to look for is the jobs market. So if you start to see a run up in unemployment, that again would suggest that you're on a trajectory for, a softer economy and or a recession too, which is something that you've got to be very minded of. So the figures in the job market, they're open to, I'm not going to say manipulation, but certainly some level of manipulation. And that is things like seasonal adjustments. So, typically through the winter months, construction lays off, agriculture, because it's pretty cold in the US and frozen, lay off. And then in the summer, you go through the halcyon times. You've also got some scenarios where you've got, a retrenching potentially through Doge of government employees, which will be joining the job market in some instances. Some will be retiring. And then at the lower end of the scale, you've got the repatriation of illegals coming out of the potential job market at the bottom rung of the ladder. So there's a lot of movement that's going on there, and I think going back to the sort of confusion that we see in the world right now, we've all got limited bandwidth. And I think any one of these things is enough to digest on its own. But when it's all happening simultaneously, so you've got geopolitics in the Ukraine, you've got tariffs going on over here, you've got political reform and big social projects going on. It's a lot for people to digest. And when people run out of bandwidth, their tolerance drops away and just sell everything. It's too hard. And again, gives you that risk to the downside sell-off.
So what about interest rates? This is a funny one because, on the surface, interest rates being cut is a good thing, right? Because you can borrow it at a lower interest rate. Happy days. Little do people realize that traditionally speaking, and I'd say this in the most general way possible, is that central banks cut interest rates to try and stimulate the economy, which can often, when you look below the surface, mean that it's not necessarily as stimulated as it should be, if that makes sense.
That's right. Interest rates or monetary policy is a great tool for trying to turn the sort of warm water on and off and the cold one on and off to get the temperature right. It's a very, very tricky process. And it's interesting because what we might be seeing is a more of what we call a normalization of interest rates. So if I think back through my 20s and 30s, interest rates in that sort of 4 to 7% rate was normal. Yet for the last sort of 7 or 8 years, we've been used to seeing effectively zero interest rate. So the norm for many people, the last decade of memory, is that interest rates should be like 0.5% or 1%. And gee, they're really expensive at the moment because, you're paying 4 or 5% interest. That is normal. But the world has got accustomed to cheap or free money. And so it's really shifted the way that business practices work. It's shifted the way that people's personal borrowings are undertaken as well, because the norm for them is lower interest rates. So they've borrowed more and now you've got to pay more. It's sucked money out of the economy. You've got a higher level of gearing there. So it is a really challenging situation to be in, because if you come in the traditional sense of, right, let's stamp inflation out by raising interest rates, given the much, much higher levels of borrowing that people have got, you're actually cutting a large slab of society and really battering them around pretty hard. And equally, if you turn down interest rates, that flow of money is quite a large quantum coming back in. It is not an easy scenario to try and get your head around, and then add the additional icing on the cake of some of the politics right now. It's a very, very challenging situation, and hence why so many people have put their hands in the air and just gone, I'm out. Give me a shout when things settle down again.
That's right. And that's why they're here listening to us, because we can digest it, make it nice and easy for them, right?
Well, quite. I mean, I had a conversation with someone the other day and they go, we've got another office in Byron, and I was having a yak with someone over a cup of tea there. Tricky week in the market. Didn't know the guy and he didn't know me. I said, well, yes and no. And he said, what do you mean? Market's down this and that. And I said, that's right, if you're holding just like a blue chip portfolio of shares or just an index tracker. He said, well, what else can you do? And I said, well, in these more difficult times, this volatility, he said, yeah, it's crazy volatility. I said, you actually can buy volatility as an investment asset. He's like, and I got the stunned mullet look as if you smoked the front lawn. I've met it's in Byron, so it's a reasonable assumption. and it's like, well, no, there are financial instruments that during times of volatility simply go up to hedge out the position. And he said, what are you doing? I said, yeah, and I had my laptop, so just fired that up, and I showed him some charts on things like UVXY, VIXY, and just the VIX index. And UVXY has doubled over the last 10 days. I said, so you're worried about the market, you're worried about volatility, you go and put 50 grand in that, it's now worth 100. How much of your portfolio loss would that have offset? And he's like, okay. So education is such an important thing through here. You happen to just throw into the mix, given your level of ability and expertise, it works brilliantly for covered calls, which It does, because the kind of income you can earn in the selling of options is much higher when volatility increases. So for anyone that's just got a pure option strategy, it's actually been quite a good time.
Yeah, I mean, also too, great buying opportunity. Like full disclosure, I really got the bat out, loaded up the account, and just bought everything. So, pretty aggressive call options as well as some leveraged ETFs with the view of seeing the market rebound potentially in the short to medium term. When the market sells off as hard and fast as it has, there are so many opportunities out there.
There are. I have to say, I introduced an element of market timing, which I'm not happy with myself over. So it was my son's birthday last Wednesday, and as you know, I've got a birthday portfolio for the kids and family. So I was due to put a slab in the market on Wednesday, which I held off on. And I'm yet to see whether that was a good idea or not. I'm actually
big day on Friday.
Yeah, it was a big day on Friday. It was also a big down day on Thursday. So net, it's kind of like, okay, well, I will get that money deployed this week, because again, as you've rightly said, it is a buying opportunity, and presence come wrapped in the most unusual wrapping paper. For anyone that was looking to get in the market a couple of weeks ago and they go, look, it's run too hard. Well, now you've got the opportunity to get in at a 10% discount, which is probably better value for you if you're a long-term portfolio holder, but you'll find another reason not to do it at the moment because of that uneasiness that comes with a rise in volatility. Psychologically, this conversation with two market professionals chatting about the reality of how to do this. Yet I've also just told you on Wednesday, I just pulled the shot. I was supposed to buy stock and I didn't do it because I felt there was more downside. Just need to take the shot and get in. And I actually explored that with myself on Friday. Like, okay, why have you held off on the back of this? And it's like, do you expect the market to be down a little bit more? Probably not. I just see it as a buying opportunity, but it could be an even better buying opportunity next week. And this is a conversation you can have with yourself.
That's a tough one.
And it is. And so, yeah, I think the go button will be happening tonight, irrespective of whether it's a red or a green night tonight. I'll be deploying those funds because I'm not trying to time the market. I just need to be in.
That's right. And as we know, when everything seems as bad as it can possibly get, and when sentiment's at its lowest, is often when you find you're at somewhere near a short-term low.
Right. So if we explore the sell-off, and okay, markets are down. We've just come through an earnings season, which actually was okay.
Spectacular. 40% better than what they expected.
So earnings were good. The outlook and guidance in the large part was all right.
Yep.
Which normally would be a buying opportunity tick box for anyone under any sort of decent sort of trading system. So why has it been selling off? And you just go back to that. We don't understand what's going on. There's fear. We're unsure. It's uncertain. Therefore, hit the exit button. And that's effectively what's driven it. So it's almost an irrational sell-off.
Absolutely.
Which means it's a buying opportunity.
Fear and greed, right? Two emotions. They're always irrational.
So parking that, so the opportunity is there. So it's an irrational sell-off. If you really wanted to be objective, there's no major economic reason. There's an anticipation that maybe tariffs might do this, maybe tariffs won't. Maybe the war in the Ukraine stops. Maybe Russia does sign a ceasefire. Maybe Russia starts selling oil in the open market, which is deflationary, which would be great news for everybody. Maybe it doesn't. So there are a lot of variables there. But outside of those factors, the market is still delivering great earnings and great guidance, now at a discount, which means technically it's a buying opportunity. You've got to try and shut out the other noise that's going on.
That's right.
Very, very difficult to do.
Absolutely. Now, question, AB, or something we can explore at least. Great for new money coming in. As you and I have both illustrated, we've both got the bat out and had a swing. If you're an existing investor, your portfolio's lost value. What other strategies can we talk about to help mitigate that volatility? You mentioned buying some. Any others that spring to mind?
Yeah, look, and on that note that your portfolio has lost value, it depends on if you're taking the value of your portfolio from the high watermark.
Well, let's just say in the last 2 months. Market's been a bit soggy most of this year, right?
So from there, what can you do? Look, there are plenty of things. You can put more money in, which effectively will help you, which you could argue is averaging down, not usually my preferred play, but you can use options to assist you in doing that. So if you, let's just say I've mentioned like tonight, Monday night, I'm going to get my orders in, that's me done. So I'm committed to buying. Do I want to buy at the price the stock is at? Or another way of dealing with it might be to sell some puts. And in doing that, what I'm going to do is get paid overs because volatility is higher. So I'm getting an abnormal amount of premium for selling puts. And I'm happy to buy at this level anyway. So it's getting me in and I'm getting paid to get in at these levels. And if the price dribbles down over the next few days or the next week or so, I was always happy to buy at this level anyway. I might have another slab of cash that I've got to put in. I'm sure I've got more birthdays coming up because we have them virtually every month, where next month I could put more in and more in and more in. But it's a good way of sort of deploying your funds by selling a put to do that too. And you just get paid a little bit extra on the way in.
Yeah, absolutely. And I think too, and this is probably a preventative measure for next time. One thing that we've done with our cash flow on demand portfolio is the protective puts. And I remember when we started to introduce that strategy more fulsomely with our trades, a lot of our clients were saying, "Oh, but I feel like we're missing out on some income selling calls first. It's a slightly different strategy compared to what they're used to." And I can say firsthand now that has single-handedly really helped us ensure the value of our positions because that protection was in place.
I fielded this question at one of our boot camps, our online boot camps last month, and it was, why are all the recommendations coming out with put protection on a month ago? It'd be really interesting to see for those people that are repeating boot camp this week, what their take is on it. And the explanation at the time was, we've been in a very, very strong bull market. Markets have moved higher. So there's good profit on the table. The cost of buying insurance is very cheap because volatility is low because markets are trundling higher. And what you've got the ability to do is just have that downside cover in play should things change. And so, are you expecting things to change? It's like, well, volatility is abnormally low right now, so it's a good time to buy insurance. And if things do, then you're covered. And if is, as I'm often reminded, a very, very small word with massive, massive consequences. And we have indeed seen that turn down in the market. So all of those protected positions, for those clients that have used them, would have done very, very well for them relative to not having that protection in play.
That's right.
And it's a good illustration of understanding what you're up to when you use options as part of your investing strategy.
That's right. And it comes back to having a level of objectivity, I believe. And I think that's where we take this podcast next, AB, is the notion of how listeners out there can handle these kinds of sell-offs psychologically. Now, I've had so many conversations on the phone with people nervous, unsure, looking for advice, which is completely normal during these times. What's your advice out there for our listeners experiencing a bit of hardship at the moment?
I think, number one, understand you're playing a bigger game than the last 2 weeks of trading and investing. And if we take strategies like hold the strike and some of the other managed strategies that we have, they've outperformed index trackers as they're designed to. Yes, they've gone down, but they've not gone down as much as an index tracker would have done. Correct, they've done what they're designed to do. So, that's something to really sort of bear in mind. Secondly, as I say, there's a bigger picture here. You're not talking about the last couple of weeks of trading. There's a longer term approach that you're taking here. And if you bought BHP at $30 or $34, it's the same stock if you're looking at it over a 10 or 15 year view, if that happens to be your mandate. Number three, look for the opportunity in this, because there are so many stocks that have been oversold in anticipation of what could, should, may, or will come down the pipeline. What is going to come down the pipeline? We don't exactly know, because we're in a situation with all these variables. What we do know is, though, the dust will settle, volatility will eventually drop, and you're going to be in a position whereby your portfolio is going to continue to move forward and business carries on as usual. And if this is an opportunity for you to buy some really good positions that you didn't want to pay full freight for a few weeks ago, now's the time to hit the go button.
Yeah. And I just think understanding that these kinds of sell-offs are normal. Don't panic, because, how many times have we seen a sell-off or a correction of 10 to 15%?
My first share investment was just before the 87 crash. So I've still got the scars from that one.
Mine was just before COVID. There you go.
Jinxed.
No wonder we're so hard-nosed.
Yeah, and it's a factor of investing. Every few years, you are going to get a sell-off. Every 10 years, you're going to get a major correction in markets. 22 was our last negative year over the most recent run out of the market. And we've had, 3, 2.5 at least very, very strong years on the back of that. And again, I go back to it. If a market's up a couple of 100% over a time frame, giving away 10 or 15% is just normal noise that you have to expect. Hurts like hell when you're the person that's in at the top. It's why you have risk management. If your tolerance is such that you're worried about downside, buying puts would have been, and there's something to add to your kit bag for next time. Having a stop loss is something I'm less of a fan of for these things, because if you have a whipsaw recovery in the market and you stop down, your decision to get back in is going to be very, very delayed, because you're going to want to see plenty of proof. So using puts in an uptrend is a better way, I think, of being able to mitigate and manage risk. But upping your risk management for next time, maybe holding more diversified assets through a series of ETFs and index trackers versus an individual share is another way that you can take stuff out of it. If you're someone that's got nimble footwork and you're across reading the tape, playing the short side through some bearish ETFs or some derivative action to the downside would have given you some nice profits there. Buying volatility, as my new T-Buddy learnt on Friday, is a way that you could protect and hedge out part of your portfolio. They're all different things you can do. So if you've been on the wrong side of this correction, looking at it and going, okay, what can I revise within my strategy to ensure that if this happens again, I'm better prepared for it? You might carry on doing the same thing. And that's not the definition of insanity, because if you're someone that's taking a long-term view, a 5 or 10 or 15% pullback in the market stings for a period of time, and it's in the rearview mirror just as quickly if you're standing the course. The key thing is not to have that knee-jerk reaction that we saw towards the back end of last week, where some people go, I'm out, just get me out. And then they miss Friday's push back up. One of the instruments I trade, I'm in at the moment, that jumped by over 7% on Friday night. And if you got out, you missed a good chunk of the recovery coming your way by panicking. You can't panic. You've got to keep these emotions under control. And it's so difficult to do if you're unskilled or you don't have a team to lean on that can give you more objective advice.
Absolutely. Great way to finish, AB. Thank you very much.
My pleasure, anytime. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.